speaking of China, it's been long suspected that, they have a lot more gold than whatever's being stated officially. But, let's say they drop 20,000 tons of gold on the table and says to other nations, let's see what you have. What happens then?
They would only do that if, let's say, the dollar got into a situation where it was really collapsing and it was threatening to take down the yuan. Now, at that stage, they probably would make a declaration as to how much gold they've got stashed around the People's Liberation Army. I'm told they've got quite a lot, if you like. The youth wing of the Communist Party. You've got all these separate accounts where gold has been accumulating. So they could well turn around, if you like, under those circumstances. But I think until then, China's approach is not to go and upset everybody. It's just let everybody else make the mistakes. And then we've just got to defend ourselves from the fallout of everybody else's errors. And that's really their whole approach. And it's, you're based in Singapore, and I'm sure you sort of get the feeling that they've got this sort of almost Confucian approach. We've been around a long time, and we don't remain being around for a long time by taking hasty actions. It's not the Chinese way of doing it.
Alasdair, do you think, though, let's say China will eventually set the price for physical gold, with the result being perhaps paper gold or maybe gold futures here in the West may not be so much anymore, or may really run into some headwinds there?
One way to sum it up is that China really does control the physical gold market. And I think she's seeking to control the paper market as well, or take the control, if you like, away from the West. And there are very good reasons for doing this. And it's a policy which has just accelerated recently because her response to American trade sanctions has been very much to take the view, right, well, as I said, we've got to protect ourselves. It's really what they're saying. And so they've accelerated, trade relations and all the rest of it, diplomatic relations around the ASEAN nations, of which I think Singapore is one. They've said, and this is really, I think, preparation for the protection of the yuan. They've said, we will open gold vaults outside China. This is a completely new departure. And so far as I understand it, they've said they're opening one in Hong Kong and they're opening one in Saudi Arabia. Why Saudi Arabia? Because that's their biggest oil supplier. So, and I actually think it's demanded by the Saudis as well. So you can see that this is sort of going into place. Now, when it comes to the paper markets, they've also opened up the Shanghai Futures Exchange to foreign institutions. And that was announced, a couple of weeks ago. And it's not just gold and silver, it's also all metals. A foreign bank, say JP Morgan or whatever, doesn't have to set up a Chinese entity in order to deal on the futures exchange. It can deal direct, just as a Chinese bank can deal direct through Globex on COMEX. These are very, very important steps. It gets very little commentary, if you like, in the public arena, but I believe these are extremely important steps, and it shows a desire by the Chinese to get control over the gold market. And why do they want to do that? They want to do that to protect their own currency, because China knows that real money, as opposed to credit, is gold. And if you're going to have a fiat currency problem, then you have got to be able to protect the purchasing power of your currency by linking it to gold. Initially anyway, really what China's looking at is looking at it from the point of view of a firm yuan for trade purposes, because obviously you've got, you've got a domestic yuan, you've got a external yuan, as it were, you've got exchange controls. This is really something which is aimed, if you like, at protecting her position in her overseas markets. Her overseas markets being the Shanghai Cooperation Organization and all BRICS. And the reason for doing this is really, I think quite simple. She can also see that as the dollar goes down, the currency which replaces it for BRICS trading. And the idea that you can accept other currencies, come on, they'll go down with the dollar. And in any event, a lot of these currencies are pretty, you wouldn't want them anyway. Would you really want Turkish lira, for example? I think the answer is no. Would you want, Iranian rial? I think the answer is no. So you can see that, there is a need for a currency common, if you like, to what's called the global South and Asia. And China is looking to provide it. At the moment, just providing it for non-domestic transactions to, if you like, guarantee her trade position. But I think if she does that with her overseas current, her external interests, then I think it will also help provide stability to the domestic currency. If it doesn't, then they'd have to sort of think about, extending gold protection to that currency. But it's all going to depend on what happens to the dollar.
And let's continue this thread, because it's precisely here, on this knife edge, that the world's monetary future hangs. We left off talking about China's approach, how they would never abruptly dump 20,000 tons of gold on the table and shout, "Checkmate!" It's not the Chinese style. Their entire history, stretching back thousands of years, teaches patience, subtlety, and the art of letting others overplay their hand. And that's exactly what they're doing with the dollar. They're watching the United States self-destruct under the weight of its own hubris and unfunded liabilities. They're watching the West run gargantuan trade deficits while simultaneously sanctioning half the planet, effectively driving countries into their arms. All the while, China is quietly, methodically securing long-term energy deals, building out the Belt and Road Initiative, and cementing relationships through the Shanghai Cooperation Organization and BRICS+. Now, many people in the West still think the dollar's dominance is untouchable. They'll say, well, the dollar is used in 88% of all global trade. The yuan is tiny by comparison. Fair point, but it misses the trajectory. You don't need to replace the dollar overnight. You just need to chip away at the margins. And once that confidence breaks, once enough nations realize there's a viable alternative, the migration happens surprisingly fast. A brilliant illustration of this came recently when Russia and Iran completed their first trade settlement using digital rubles and reals on the Russian MIR system, completely bypassing SWIFT. It was a mere $20 million transaction, a drop in the ocean. But symbolically, it's colossal. It proves that workarounds exist and that you can escape the dollar if sufficiently motivated. Meanwhile, the Chinese have been executing what we might call the soft encirclement strategy. You look at the announcements from Beijing just in the last 6 months, opening new vaults in Hong Kong and Saudi Arabia, preparing the ground for a future where gold is directly linked to trade settlements in yuan. Why Saudi Arabia? It's obvious. It's about securing oil flows outside the dollar system. It's part of a larger mosaic. They're also opening the Shanghai Futures Exchange to foreign banks, allowing them to trade gold, silver, and base metals directly without needing a local subsidiary. That might sound like a dull technical tweak, but it's monumental. It means a JP Morgan, a BNP Paribas, or an HSBC can now play directly in China's metals markets. In time, pricing power shifts from London and New York to Shanghai and Singapore. A recent column in the South China Morning Post argued bluntly that the age of Asian price discovery is dawning. You don't hear that in the FT or Bloomberg. They're still stuck on Wall Street being the center of the universe. But the flow of physical metal tells a different story. The East buys. The West prints paper. Eventually, the East will set the price. Now, I've had some chuckles on this. People send me memes on Twitter, or X as it is now, with a cartoon of Uncle Sam selling gold IOUs for decades, while a fat panda calmly stacks physical gold bars, smiling. It's crude, but it's also painfully accurate. The COMEX and LBMA have evolved into mechanisms for price suppression through massive unbacked paper contracts. And that only works when people don't stand for delivery. But guess what's been happening since November? Exactly the opposite. We're seeing record tonnages being demanded for actual physical settlement. On COMEX, over 35 tons of gold stood for delivery since Easter alone. In May, we saw the largest combined deliveries of gold and silver contracts in history. And it's not retail investors doing this. It's the big fish. It's sovereign funds, perhaps even quiet government proxies, draining the Western vaults. We also have to remember what the ECB just admitted in their Financial Stability Review. They basically said out loud what we've long suspected. that a large proportion of gold derivatives in the Eurozone are over-the-counter and not centrally cleared, creating counterparty risk. In other words, they're terrified that if too many parties suddenly demand actual gold, the whole pyramid collapses. It's reminiscent of that old Warren Buffett line. Only when the tide goes out do you discover who's been swimming naked. Well, the tide is rapidly going out on the Western gold suppression schemes. If you overlay this with China's patient strategy, absorbing physical metal year after year, while letting the West issue ever more unbacked claims, it becomes clear what's coming. And here's where it gets particularly fascinating. China doesn't want chaos. They don't want the dollar to collapse tomorrow because it would devastate their export markets. They want a managed transition. That's why they're carefully internationalizing the yuan step by step, opening vaults abroad, inviting foreign players into Shanghai, positioning the yuan first as a trade currency for the global south, then potentially as a reserve currency backed by gold. I've spoken to a number of well-placed contacts in Singapore and Hong Kong who say the same thing. The Chinese are preparing for a day when they'll quietly declare, "Our external yuan is now backed by gold at a fixed ratio." It won't be for domestic use initially. They want to keep capital controls to manage internal stability. But for cross-border trade in the BRICS Plus, Belt and Road, and Shanghai cooperation economies? Absolutely. And why wouldn't they? As the dollar weakens, you need a new anchor. You can't trust the Turkish lira or the Iranian rial. You need something that gives confidence across wildly diverse trading partners. Gold does that. And by controlling the world's largest vault infrastructure and the flow of physical metal, China positions itself to dictate those terms. Now, what does that mean for us in the West? Well, it means the days of gold and silver being just quirky inflation hedges are coming to an end. They're about to return to their historical role as the ultimate settlement money. And when that switch flips, when enough countries no longer want to hold treasuries because they see the US running trillion-dollar deficits as far as the eye can see, and instead prefer gold-backed instruments, you'll see a price reset that dwarfs anything in living memory. A lot of people misunderstand this. They think, well, if gold goes up, it's just speculation. Number, it's the dollar going down. It's confidence in fiat evaporating, and it's happening precisely because the old financial system is rotten with debt. When your debt to GDP exceeds 120% and your interest costs alone outstrip defense spending, it's not a question of if, but when the system resets. Some viewers might remember when Trump tweeted, or Truth Socialed depending on your flavor, "He who has the gold makes the rules." That wasn't an accident. Nor was it accidental when Judy Shelton said that she was told by Trump that he'd issue gold-backed 50-year treasuries starting on the 250th anniversary of the United States, July 4th, 2026. Whether that happens or not, it shows the conversations at the highest levels. Meanwhile, back on the ground, we see US states like Florida, Texas, and Utah passing laws recognizing gold and silver as legal tender. It's a form of soft secession from the dollar's monopoly. They're saying, we don't trust Washington's spending. We want parallel systems. Even if it starts small, it's telling. It's part of the same global pattern. So yes, I firmly believe China will ultimately set the global benchmark for gold. They already control the flow of physical. They're now opening up to control the paper pricing too. And that's where the future lies. Not with over-leveraged Western futures markets, but with direct, allocated physical settlement. Where does silver fit? Silver is gold's slightly crazier cousin. It's more volatile, but it has the same DNA. In fact, as we approach the endgame of this monetary experiment, silver could outperform dramatically. We've seen the gold-silver ratio hit extremes over the last decade. Every time it normalizes, silver plays catch-up in a violent fashion. Right now, on a long-term chart, silver has built this massive 45-year cup and handle base. We're right at the lip of that cup. If silver breaks decisively above $38 to $40, there's very little standing between here and the old highs near $50. And remember, those $50 levels from 1980 and 2011 were reached under far less dire monetary circumstances than we face today. Adjusted for actual monetary inflation, silver should be closer to $150, and that's just to stand still. If there's an actual rush to hard assets, all bets are off. I wouldn't be surprised to see a spike to 100 plus as part of the blow-off. Not because silver becomes intrinsically more valuable, but because fiat becomes intrinsically more worthless. And that brings me to a final point, which is really a message to everyone watching. It's not about trying to pick the perfect exit price. It's about survival. It's about return of your wealth, not return on your wealth. In a world teetering under record debt, in a world where the ECB itself admits the gold derivative market could implode, your number one priority should be to own assets with no counterparty risk. Gold and silver fit that bill like nothing else. So, my advice is simple. Keep stacking. Be patient. Understand you're not speculating on a commodity. You're buying monetary insurance. The next few years are likely to be some of the most consequential of our lifetimes. When the dust settles, those holding real assets will emerge far better off. Those still clinging to paper promises may learn a very hard lesson. And if all else fails, at least you'll have something shiny to barter with when your neighbor comes by asking to trade for your garden tomatoes. Yes, that's a bit tongue-in-cheek, but only just. Because history teaches us this: all fiat currencies eventually fail. Gold and silver don't. And we're about to be reminded of that in very real, very painful ways.